With everything that's happening in the market right now and all the amount of cash out refis we're seeing, are you waiting for the other shoe to drop? Hi, I'm Nick with the ENED Realty Group. Just wanted to come at you with a real quick housing update for the month of March here in San Diego. But of course, I always like to provide a little bit of context of what's going on all around the country. And looking at the snapshot, kind of our year over year changes in some of the key metrics, we're seeing that nationwide showings are up by almost 50%. Mortgage applications are up almost 40%. Our pending deals are down about a half a percent. Our existing home sales and new home sales are up 9 and 8% respectively, but our existing inventory is down by about 52%, and new home inventory is down 4.6%. So still not ideal. When we're talking about mortgage rates, obviously these are still spurring on a lot of buyer demand. We did recently see that rates have been ticking up here over the past 2 months or so, but I want again to provide a little bit of context. Just realize that you know mortgage rates from 3 to 3.5% historically are still incredibly low. They are extremely affordable when you consider back to the 1980s and things like that, where we saw interest rates as high as 18%. So just kind of keep that in perspective. I have a lot of younger clients that have been kind of jaded with some of these lower rates, but still, when you consider the amount of inflation, the tax write-off you're able to get, it's still 3% is practically free money. When we're looking at our year over year change in listings, our existing listings here are in orange. We see that those have steadily been declining. Our new listings have been coming up. We saw a sharp decrease here at the beginning of the year. That's obviously kind of some seasonality there, but again, the new listings are just not enough to put a dent in what we have going on. I thought this was incredibly interesting when we look at the year over year change in housing inventory. Only Hawaii and New York had changes where they were down about 10 to 12%. Everywhere else in the country, we're seeing more than a 30% reduction year over year in housing inventory. Here in California, we're at 41.3%, which is it's incredible, actually, right? So all of that on average, we're looking at about 52% reduction in year over year inventory. That's crazy, right? Dr. Lynn Fisher, she's with the FHFA. She said home prices nationwide recorded the largest annual and quarterly increases in the history of the FHFA, and the low mortgage rates, pent-up demand for home buyers, and limited housing supply propelled almost every region in the country to experience faster growth in 2020 compared to the year prior, despite the pandemic. I think this is interesting to look at. Realize for the past 13 years, we have been below our 50-year average of new home starts, right? We're just not building enough new inventory to keep up with our population demand. Keep in mind too, there's always been talk over the past few months here as these prices have been increasing, comparing what we're doing now to the housing crash of 2008. Realize we had record levels of new inventory coming to the market then, and I'll talk about that a little bit more here in a second. But I know I've started to hear a lot of talk from my other clients recently about just the amount of cash out refinances, and are we headed for a crisis there? Is that going to be this other shoe that drops? Kind of what we saw leading up to the housing crash, where all these people were pulling money out of their homes and buying boats and other houses and all these other things, right? And I just wanted to again provide some context. I know that we now have far more tappable equity, right? As we're coming into 2020, prices have been steadily increasing, and realize that since the crash, we as a nation have been far more responsible with the amount of equity we've had in our homes, which has been a good thing, right? But for comparison's sake, when we look at what happened in 2006 in reference to billions of dollars, we pulled out $321 billion through cash out refinance in 2006. Here in 2020, we've only pulled out 153 billion, so less than half. Right now, keep in mind this has ticked up quite a bit from 2018, 2019. Like I said, here you can see where we've been using the equity pretty responsible. I think this is just due to the pandemic. People were stuck in their home. They couldn't take vacations. They've been looking at that same old beat down kitchen for a long time, or they needed an addition. They needed some schooling area. They needed an office, things like that. So it just made sense with low rates to pull some money out. However, I thought this was incredibly interesting. When you look at, in red is 2006, and just this past year, 2020 in blue. When we look at the tappable equity in trillions of dollars, back in 2006, we had 4.6 trillion. Today, we have 7.3 trillion. When we look at the percent of cash out refinance, back in 2006, almost 90% of all refinances were cash out refinances. Now, keep in mind, rates at this time were increasing. So not many people were refinancing just to refinance. They don't want to refinance to a higher rate. They refinance to pull that equity out. Whereas now we only see about a third of our refinances are cash out refinances because people are aggressively trying to lower their interest rate, right? To lower the cost of their mortgage without necessarily pulling money out. So again, in 2006, we pulled out 321 billion. This past year, we pulled out 153 billion. When you look at the percentages of what that represents, 2006, we had $4.6 trillion and we pulled out 7% of that. Now we have $7.3 trillion and we've only pulled out 2%. Okay, so again, using that equity in a far more responsible manner. The Wall Street Journal noticed that, the real estate market's been on the biggest tear since 2006, just before the bubble burst and led to the global recession. Yet in nearly every meaningful way, today's market is the inverse of the previous boom, right? You have to look back in the mid 2000s. A lot of people were getting money for mortgages that should not have been getting that money, right? We'll talk a little bit more about that. And I thought this was interesting as well too. From the National Association of Realtors, they know that demand for homes is outpacing new listings. Buyer competition continues to intensify, and on average, there were about 4 offers per home sold in February. Here in California, we're seeing way more than 4 offers per home. I just had a new listing that hit the market in Poway. In 3 days, we garnered 53 showings and were able to achieve 18 offers. But I think what's really telling is down here, I always talk about months of inventory, 6 months being a healthy market. Right now here in San Diego, we only have 0.9 months worth of inventory. But estimates are about 2.7 million homes are going to be required to get us back to a balanced market. I've seen estimates as high as 4 million new homes are going to be needed to get us back to a balanced market. Realize that amount of homes is not going to be built anytime soon. And what we're seeing with these number of offers is just simply, a function of supply and demand. So is this like the last time? I have this conversation almost daily with different clients, and no, it's not, for a lot of different reasons. This I thought was incredibly interesting. When you look at the months of inventory, right, we've had a steady reduction here over the past few years. When you look at what happened leading up to the crash, there was a big increase, actually, right, historic increases in the amounts of inventory. When you look at the annual appreciation price right now, we're at 6.3% annual appreciation, right, which is a manageable number. Also consider that we've had a reduction in inventory, right? So that follows the typical economic supply and demand model, right? And when things are in demand, the less supply, the higher the price is going to be. So we're seeing less supply of homes and the price is being increased. Whereas when we look at what happened here, up to the crash, we had record amounts of inventory. Inventory was coming on and on and on, yet we still had an average annual increase of 10.3% in the price. That didn't necessarily make sense, and that was a key indicator leading to believe that the things were actually overinflated. When you look at it from the amount of risk, this yellow line here is the reasonable lending standard for risk. Well, before the crash, there was a lot of risk in product. We had so many new homes coming to market, and there was a lot of risk for the buyers, right? People were getting mortgages that should not have had them. When we look at what's going on today, we basically see the reverse of that trend, which is good news, right? Oded Akushi said that, this isn't just a seller's market, it's a super seller's market. And that is, not an overstatement by any means. But what I want you to take away is just the sheer amount of equity. I don't think people understand just how much equity they potentially have in their home right now. The average gain of equity in mortgaged homes last year was $26,000, right? The average equity in mortgaged homes is about $200,000. Realize here in California, we're a little jaded with numbers, but in other parts of the country, that's a significant amount of money. It's still a significant amount of money here. But the other thing too is I want people to realize, I've been talking about this for quite some time, 38% of all homes in the United States now are owned free and clear with no mortgage. That is huge for the stability of the market. When we look at the year over year change in home equity, what's crazy is, when we look here in the West, we're seeing things upwards of, above $30,000 in year over year equity. Here in California, the average homeowner was up $55,000 in a single year. Nationwide, we're looking at $26,000. So those are huge, huge numbers. Okay, so Coming back to reality here in San Diego, what we're looking at, remember, these are all median numbers. This is for March 2021. Okay. Our sales price, this is countywide median numbers, all housing types, detached condos, townhomes, everything all together. We were up 16.3%. Our active market time was down 30.8%. That means things are selling faster. Our sold price per square foot was up, a little over 18%. And our months of inventory was down 59% year over year. Okay. Remember, everything above the line are our lagging indicators where the market has been. Everything below the line are our leading indicators. This is telling us where the market is going. Our active listings are still down 55%. Okay. New listings were up 2.4%. That's great news, but it's only up 2.4%. So, not encouraging. We need that number to be much larger. And then our pending listings and our sold listings are both up 54% and 17%, which tells us that things that do hit the market are selling much quicker. So they're easily being absorbed. So anyway, if you have any questions about what all these numbers mean, if you have questions about how much equity you now have in your home, I'm more than happy to have that conversation. Of course, if you have any questions about, whether this is a good time to sell or buy, always happy to have that conversation as well. Just reach out, and that's it. Thanks so much for tuning in. And remember, who you choose to negotiate for you absolutely matters.